I win 500,000.
Okay.
And I call you up.
What will we do?
What would we do?
Well, I guess let me tell you a little bit about my background. I didn't really go into that. When I first came out of school, I worked for Citigroup, Solomon Smith Barney. I was a wealth banker with Citigroup. And I was also an asset manager with UBS Payne Weber. Now it's UBS Financial Services. So I've done some wealth banking before I got into real estate investment banking. What I do now is more real estate based. So whenever I take equity money in, I'm placing it into a real estate deal. It's going to be some type of a development, or it's going to be a developer we know that are buying, I don't know, apartments, and they're improving those apartments in some kind of way. But there are people out there, really good buddies of mine, that still work at UBS and Morgan Stanley and some of the other cash houses that if you wanted to put your money in the market, if you want to put it in the stock market, that wouldn't be something I would do. I'd send you to someone else. But I would only do something that's real estate based. And it's really different the way we do it, because if you go to a financial advisor at Morgan Stanley and you say, hey, I want to be in real estate, and I will tell all of you guys, if you don't have some exposure to real estate in your retirement portfolio, you need to make sure you have some exposure to real estate. Real estate is what we call a mainstream asset class nowadays. 10 years ago, if you went to your financial advisor and you wanted to invest money, he probably would only put you in stocks and bonds. That was the norm back then. Now they're recommending that you do have a position in real estate. The main difference between the way we do it and the financial advisor would do it, he's going to put you in what we call a REIT, which is a real estate investment trust. In a sense, what you do is you buy shares of the REIT, and then the REIT takes that money and they go out and they buy real estate. And the reason why real estate REITs are really effective is because as long as they distribute most of their earnings back to the shareholders, they don't pay taxes on them. So it's a really good way to get exposure to real estate. But if you want to be in a deal, what we call a deal, if you want to be part of the deal, that's not a good way to do it, because you're just buying into an operating company that happens to buy real estate. You're not in a true deal. So you're riding down the highway and you see a shopping center getting built. If you want to be in one of those kind of deals, a real deal where you could ride by it every day and say, hey, I've got a share in this development, that's what we would do. But if you wanted to buy into IBM or Google, which is what you need to do that too, you would need to go talk to a financial advisor or wealth banker, which I know several, and they would love to just file in line for all you ladies' business, I promise you. So I can give you those names and numbers out.
Thank you.
Yes, ma'am.
When you talk about investing in real estate, would that be like the tax credits when developers go in and they issue you money back? Like you put so much money back, you earn so much in tax credits?
Yeah, those are tax credits. That's not truly, once again, being in a deal. When I say being in a deal, and I'll go back to the example I gave for you. If I have a developer come to me and he says, I want to build a shopping center, it's going to cost me $10 million to build it. What I would do is structure the debt. So we'd say maybe 80% of that's going to be in debt. So $8 million of it is debt. So we have $2 million in equity we have to raise. That developer may put in $500,000 of his own money, and then I go out and raise the other 1.5. And I would do that with individual investor money. That's how we would raise that capital, and then they would be in the deal. Our average investors are making, on the minimum side, 15% of their money. Some guys are making 25, 30% of their money. So the returns definitely beat anything that you get in the stock market. Our setup, if you've ever heard of hedge funds, our setup is basically a hedge fund. That's what it is. The only thing about us that makes it difficult when I come out and do these kind of talks, like I was explaining to Mosaic, the thing that makes it difficult for us is you've got to have about $100,000 before we can invest your money. So it's not always a good fit for people who are wanting to do small investments. If you're wanting to put $5,000 or $10,000 in the market, we're not a good fit for that. So if you're a smaller investor and you want to get exposure to real estate, I do recommend you go out and buy REITs, because it's a good way, if you're a smaller investor, to get into the real estate game. And then once you earn some capital and you actually want to start doing deals, then we can recommend you do, and it's not going to work in this market even if you tried it. You're not going to be able to flip houses. Flipping houses is when you buy a house, you don't really do anything to it, or if you do anything to it, it's very minimal, and then you try to flip it or you sell it really quickly for maybe a $10 or $20 or $30,000 profit. That's just not going to work in today's market any longer. You can go in and buy houses at depressed values, houses that are being auctioned off, and then invest money into those houses and then rent them back out. That's a great strategy. Let me dispel another rumor for you as well. If you're thinking about doing that, Some people think they're gonna buy houses and they're just gonna get a tremendous amount of cash flow off of them. It does not work like that. You don't get a tremendous amount of cash flow off of residential property. And the reason why is because the way it works, you finance the house. About what you take in off of the house is gonna be enough to cover that mortgage payment, more than likely. You know, a good rule of thumb is if you have a house and you wanna rent it out, you normally can rent it out for about 1% of the value, or 1% of what you paid for it. So if you paid $150,000 for it, you can rent it out for $1,500. That's normally what the market says. But that's normally gonna be just around enough to cover the mortgage payment. So a lot of times you may even be coming out of pocket to pay the taxes and insurance, but that's okay. Some people get afraid when they see that or they hear it. It's okay. When you invest in residential property, what you're really trying to get out of the asset is the appreciation and value, because all the appreciation is yours. You get to write the taxes off your when you pay the taxes, the county taxes, you get to write that off your federal taxes, so that's a tax deduction. You get to write all the interest expense off, so that's another tax deduction. And you're building equity up in the property, but you're not even building it with your own money, you're doing it with somebody else's money. So just when you buy residential property, don't buy it under this idea that you're gonna have a tremendous amount of cash coming off of it. You're really not, but it is a good investment, but it's a slow, steady investment. Now, commercial property is a little different. You can buy a set of apartments, you may be making $100,000, $200,000 a year off those apartments. Commercial property generates a lot of cash. They throw off a lot of cash, but they're a lot harder to buy because they're so much more expensive. So lots of people will start out in the residential area, make some money, raise some money to invest, and then they tend to move into the commercial area. These are all good questions.
Even with the foreclosure houses, you don't think you would make enough money? Because with them, you're buying them at what's actually owed.
I mean, potentially. It just depends. I mean, it depends on what you bought it for. I mean, if you bought it at a value that was depressed enough, you could. I mean, I know a guy right now, he just bought a house in foreclosure. I think he bought it for maybe $40,000 or $50,000. He's got it under contract now for $110,000. See what I'm saying? So yeah, I mean, if you're buying houses at depressed values, yeah, you can make a lot more money off of them. But that's not what was happening in the last year or two of our market.
And even with the